Hey, good evening, everybody. This is Bob, Trade Genius, is our podcast. And tonight, what I want to talk about is probabilities in trading. And I'm going to talk about it by day of the week, by the time of the month, and also opportunities if you're trading in the futures markets, best times of the day to be long and to be short. And so, first thing I want to, and then some strategies around that so you can um, bring alpha to your game, which means try to outperform the market. So, the first thing I want to talk about is when you look at the marketplace, um, there's actually a rhythm to the stock market. And I'm going to talk specifically first about ES or SPY or SPX. Then I'm going to touch on a little bit on oil, and then I'm going to touch a little bit on gold. And so the first opportunities when you look at the marketplace is really the times of the year when the marketplace is in bear mode or in bull mode. And these are ones that are pretty obvious to most people, but a lot of times when the market, we get a dip going into the end of the first quarter. And we've seen that this year. And then actually April through June on typical year, the market is in a bull mode. And then as you go into the end of the second quarter, June is a month that typically dips. July and August are also, you go into bull mode. And then September obviously is the worst month of the year. And sometimes that bleeds into October. And then November, December typically, completes itself as in bull mode. And there's a reason for that. And it's getting more and more pronounced now because you have contracts expiring and around the quad witching, with options. And now options are taking a bigger and bigger role in pricing of stocks because of the way in which options affect the price of stocks, and especially the indexes. So, it's a balancing that happens as you get into these quad witches. And so you have these movements into these quarterly contract expirations. And so that's one of just the broadest thing to bear in mind. And there are going to be some strategies I'll share with you around looking at different moving averages or different trend bands and things of that nature to get you on the right side of the trade. But for now, just to suffice to say, that is typically a seasonality that is pretty well known out there. But I thought I'd just bring it up. The second one that should be really well known to people, but a lot of people forget about it, is really the end of the month, beginning of the month trade. So I don't know if most people don't realize, but most of the money is made in the last 2 days and the first 3 days of the trading month. And obviously, that has a lot to do with front running the money that comes in from the 401k and rebalancing at the end of each month. And the rest of the month is actually neutral to a little bit bearish compared to those 5 trading days. So it's something you could bear in mind, and there's strategies that we'll talk about that you could take advantage of those. And so now the time of year, then the time of the around the month, and then when you look at during the week, there's also strategies associated with that. And so when you look at the week, so a lot of times, and I'll give you some exceptions to the rule too. So when you look at it Monday through Friday, Monday is typically flat to a little bit positive, with one exception, which I'll get to. Tuesday is invariably the best day of the month to be long, hence the term turnaround Tuesday. It's basically, it has the highest percentage chance for it to be green from Monday close to Tuesday close. Wednesday, we call it wishy-washy Wednesday because it's kind of a neutral day. And reason being is there's a lot of theta that's being burned off. That's a Greek A lot of the option contracts now have weekly contracts associated with it. Also, SPY has a weekly contract on Friday, and then they have one on Wednesday as well. And so there's option contracts that need to burn off value from the market makers. So a lot of times there's a tug of war on Wednesdays, and we even seen it today, tug of war, and it pushed down because Monday and Tuesday were so strong. And then you have Thursday. Thursday typically is the most reliably bearish day of the week. And then Friday is actually neutral to slightly positive. Now, there's one big exception to all these rules is that if we're in a bear market, the market tends to be down on Friday, and the kind of the general rule is if down Friday, down Monday, and then you have a strong turnaround Tuesday. In a bull market, up Friday, up Monday, and then Tuesday is slightly positive, but it's not nearly as robust if it was a down Monday day. So those are some of the things that are associated with the the days of the week. Now, a strategy that you can employ when doing it is that um, another thing that's quite interesting is that the market tends to be from the close to the open the next day is invariably positive. In fact, there's studies been done from looking at long-term back testing that if you trade it from the close to the open and then from the open to the close, that you would have made most of your money with the overnight action. There's less volume, there's big money involved, and then when the big markets are open, like in the US and the European markets are open at the same time the next day, they tend to suppress the growth in the index. So most of the money is being made in those low volume overnight periods of time. And so a strategy that a lot of people employ, and it's one to think about, is that you can either do buy a SPY call going into every evening, and you think about it as kind of a campaign, not a transaction. You got to make sure that you're slightly in the money because you want to minimize as much theta or overnight time burn on the option as possible, and also the volatility if it's getting crushed, meaning the value of the option goes down for no other reason why it's less risky, is then you put yourself in a position to actually create and harvest some cash and close the trade by the morning. And that's a strategy you can employ. Typically, if market's up on Friday going into the close, you could go for a trade going into Monday, a trade from Monday into Tuesday. I would not do the trade on Wednesday. I would go short and buy puts on Thursday, and then I would employ the trade again on Friday, Thursday into Friday. If that's too directional for you, you could do what's called a credit spread, which means that you're selling and buying a call or a put that are both out of the money, and you're looking to harvest premium and taking advantage of the time decay. So that's an opportunity for you as well. And in that way, you don't have to be right, you just have to not be wrong. And if you're going directional, you want to give yourself a couple of expirations into the future. So, for example, if you're putting this trade on Monday, you want to be buying a Friday contract on SPY. Tuesday, a Friday contract on SPY. Wednesday, you're looking to buy a Monday contract on SPY. Thursday, a Monday contract on SPY. And then on Friday, you're looking to buy a Wednesday contract on SPY. So that's the general rule. You need to give yourself some time on the trade, and so you're not getting burned on the theta. Unless you go deeper in the money, then you can pick any expiration close that you want. And then obviously, if you're going ahead and doing credit spread, you want to be as close to expiration as possible so that you can go ahead and harvest the premium and close the trade the next morning. So that's kind of the overnight trade, two ways in which you can take that trade and take advantage of it. And then the other thing that you want to do if you're trading futures, there are times of the day where the market tends to be in bull mode, and times of the day when it tends to be in bear mode. And those times are, if you look at a clock, and the day starts with the futures at 6 p.m. Eastern time. I'm in California, so I'll give it to you my time frame because that's the one I always look at. Easier for me to do the quick time calculation. Is that basically from 3 p.m. until the Asian market closes, which you're looking at around 10:30 p.m. my time. It really has not availed you to really take a trade. There's some esoteric trades you could take in the Asian market, but unless they're very active, something's going on in China, it's usually not, there's no alpha in there for you to, or benefit for you to take a trade. But from 10:30 p.m., into midnight, even all the way up until 1 a.m., there tends to be a bullish bias to the market. The Asian market is closing, the European market is opening, the Asian traders are taking risk off, and they're taking their trades off, and so it tends to lift the market. And then from 1 a.m. to 2:30 a.m., it tends to be a push down or reversal in the market. And then starting from 3:30 in the morning, my time, until about 5:30 to 6 in the morning, my time, half hour before the market opens, there again tends to be a bullish bias to the market. And then you go into the opening of the day, and then that usually is a reversal from what happened into the open, as traders are taking profit from their overnight action. And then there's some really interesting reversal periods during the trading day that might be interesting to you. So you have um, from 10 a.m. to, or 7 a.m. to 7:15 a.m. my time, is that you tend to have a reversal of trend, and these are tactical reversals. Okay, and then assuming that Europe and the U.S. are on the same uh, daylight saving times or regular trading hours times, is that you have Europe closing at 8:30, and so there tends to be a reversal from that 7:15 into 8:30 a.m. Now, one thing is really interesting: if the market is pushing down from the open into that time period from 7:15 to 7:30, it tends to V reverse back into about 8 a.m. So that's something to put in your notes, and just observe these things. It's pretty fascinating, and these moves are big enough to be worthwhile taking some intraday SPY call trades or SPY put trades, and so on and so forth. And if you're a futures trader, obviously you can just go long or short. And then typically at the bottom of the hours are reversal periods. So Europe closes at 8:30, but it has like multiple closes until 9:30 in the morning, my time. And then you start seeing what's really interesting between 10 and 10:30. There tends to be a bullish bias in the market. And this is of late. Usually it's pretty neutral, but of late they've been lifting the markets between 10 and 10:30 in the morning. And then when you get into 11 a.m., which is like 2 p.m. East Coast time, is the institutions start getting busy again, creating their trades for the next day. So you need to keep an eye on that time of period because it'll tell you whether or not the market's going to close on a bull note or a bear note. But there's a reversal that tends to happen going into oil close around 11:20 a.m. So it'll actually counter trend whatever's happening from 11 a.m. to 11:20 a.m. And then you get a reversal for about 20-25 minutes. Why it takes 15 minutes after oil market closes, but I'm sure there's just a lot of back and forth and reverb until about 11:45 a.m. And then you get your move into the close. A lot of times if the market is down going into this period of time, towards the end of the week on Thursday or Friday, you'd see some reversals into the close as traders take off risk. And so that's kind of the time of day thing. And there's a couple of other really interesting exceptions. If the market is down, from basically Monday's open until about Thursday midday, there's a trade from Thursday midday into Friday close that tends to reverse and go positive. The reason being is traders are taking off their risk. If they've been shorting the markets, they're closing their profitable positions going into the weekend. A lot of these traders do not have positions going into the weekend as a general rule, and many of them close their positions at the end of the day too. And that's why you get those lifts going into the into the Asia close, and you get those lift again when the U.S. market opens. Against what the Europeans have been trading when they're by themselves. And so those are some just really interesting dynamics, and that tends to be for ES. I really haven't studied too much on NQ and small caps, and sometimes they don't. They vary because the traders will hedge their ES position or their SPX position against the small caps and the tech stocks. But this is really around ES, SPY, SPX. There's also some really interesting trades on oil. There tends to be, regardless of what oil does overnight, there tends to be a trade between 5 in the morning and 7 in the morning where if there's a dip in oil, it's a tradable dip. And enough for you to make money on futures contracts, or if you're trading binary options, to be able to take that first trade in the morning, that I guess that 10 a.m. trade, and it's a high probability win. Another high probability win is when you trade oil. Thursday close into Friday close, it tends to be a bullish bias over 70% of the time. I personally back tested this, and that's good enough to take trades on. You do it with binary options going into the end of the week. You can do a futures contract. You can buy UCO. You can sell SCO put spread. You can sell USO put spread, uh, and so on and so forth. You take advantage of those trade dynamics. And then the final trade is on gold. Is that there tends to be a trade that's really observed, once a month. Is that the Wednesday into Thursday of the week in which the unemployment report comes out, gold tends to get sold at a high probability rate. And up until lately, they used to sell gold off from 5 a.m. till the U.S. market opens. There tends to be a gold raid in the futures markets. I think that's changing a little bit now that I think gold is waking up, but it's something to always keep an eye on. That's a high probability trade in the morning. Is that the traders come in, they're getting their marching orders from the miners that are selling their product forward, so they can collect the cash to run their business, and they sell the market right at the open. And so, or even before, they are open. Sometimes 5:30. You see these massive front running of these contracts being sold ahead of the gold market officially opening. So anyway, I thought I'd share those with you guys. They're something that we trade a lot. They have high probabilities, and they're reliable. And mathematically, the probabilities have played out over many, many, many years. You just have to know when you're in a bear mode, in a bull mode, which you're going to be in bull mode probably more than 75% of the time, bear mode about 25% of the time. So I have a few more of these probabilities I'll share in later podcasts, but I thought this would be kind of good for you guys to chew on a little bit. You might have to listen to this a couple times to write them down, but I thought I'd share them with you guys. Anyway, you guys have a great night. I'll talk to you later, hopefully tomorrow. Bye bye.